Hello, guys. Welcome back. We were discussing about leveraging, and I was trying to explain you the Hero Motors, how it is leveraged through Hero Finance Corporation. As in the last lecture, I've already explained you that because of this structure and because of this whole equity method of accounting, it is able to hide almost more than 10,000 crores of liabilities, and obviously it is about 13,500 crores of assets, which is pretty legal. I mean, it's not something illegal. But again, when you are trying to consider trying to measure and figure out what is the leverage, I would say you will have to recalculate this, and you will need to get the percentage. So basically, Hero Motors owns 41%, I think, of Hero Finance, and you need to get this back, and then you'll see the whole leverage ratio actually changes a lot. And oh, basically, what you'll need to do is you'll need to have uh, so that means they are actually taking more risk than what they show. What that means is your rate of return, expected rate of return, needs to be increased. So that's the whole objective, what I'm trying to say. So obviously, that's a different topic. So when you are valuing something, the main thing what you usually figure out is what's the risk. Based on the risk, your expected rate of return is more if the risk is more, and vice versa. So, so that's one thing we'll need to keep that. So now coming back, so we looked at the balance sheet. Other than that, everything else is pretty okay. Their equity, their equity share capital and everything is there is nothing alarming that needs to be seen. Obviously, we'll be going through the footnotes again later on, but this is just a high level overview. Now, let's look at the second thing is the profit and loss statement, which is also called the income statement. So here we are looking at what are the revenues and what are the expenses. The first thing that I would like to point out is the excise duty on sale of goods. So if you look here, it had a sale of 31,500 crores in 2017, and he paid an excise duty of 2,300 crores. And in 2018, it actually sold more, but the excise duty is way less. This is because the excise duties, all the that's basically the rate which is decided by the government every year when they announce the budget. It changed and it favored them, which is good news. But guess what? The elections are coming up. So the next year, this year, we might get a new government. Something else might happen. We might get a new finance minister. There are a lot of uncertainties, and the excise duty, they might not end up paying the same amount. It might actually again go back. So when you are trying to estimate for that, remember to always go and look at the average rate and put a good buffer. And again, I'm trying to remind you, remember factor of safety. So you have to always look at more conservative and rather than looking at and thinking, oh, excise duty will always be pretty less. So that's one thing. Second is obviously the cost of material consumed. That's a very big amount, and we'll need to analyze that in detail. So let's go back and look at the footnote number 29. So here we go back here. So that is footnote number 29 is let us go back down here, figure out what page it is. It is page number 247. So page number 247. Okay, so here is the details of the cost of material consumed, which is okay. Uh, like they've added 22,000 crores of materials, and then their net consumption was about 21,900. So obviously their inventory a little bit increased. But now if you do the math, so uh, the total sales is 33, and you're spending about 22 on cost. So that is like 2 is to 3, right? So out of every dollar that they get from the sale, about 66 uh, cents, or maybe you can say about 66% of their, expand like their revenues goes towards, buying all the raw materials that is needed to, and the spare parts needed to build the motorcycle. Now, another kind of big thing is actually other expenses. That's usually, I don't know why they do that, the companies. They tag it as other expenses, but usually it's supposed to be a really small amount. But uh, as time has gone by, the companies have been more given leverage, that because their businesses are becoming more complex, to put more and more things in the other bucket, which is kind of an umbrella. So let's look at that carefully and see if there are any red flags here. So that's note number 33. So just go down here. So that is the details of the other expenses. So here, out of 3,600 crores, the two biggest expenses are, one is packaging. They're spending about 1,000 crores, and advertising and publicity, about 850 crores. About almost half of that is going. So, but this is about almost 1,900 crores. So just more than half goes towards here, and about 900 crores is miscellaneous, which to me is a little bit in a higher end. But you know what? You have to just uh, accept it, because if you're going to write a letter to the chief financial officer and saying, "Sir, can you explain us what is this?" He'll be like, "No, I don't need to explain." So there is no way you can actually know it unless until you have good connections. So what we will assume is these are all other expenses. Let's say something the company is, uh, setting it aside, or something to do with their legal expenses, this, that. So we'll just kind of assume that way. And as a fair this thing, you can set a percentage of this as, like for every revenue, like that means that it was 33,000 crores, 1,000 crores is miscellaneous. So you can set it aside like that when you are, building your valuation model. So these are the main, and for all other things, so that's another thing about when you're building a valuation model, you're trying to figure out how much cash they're going to generate. You can kind of club a lot of these small things, like, like rent is 43 crores. So you don't have to, go around trying to estimate everything, because again, remember, the whole objective is to just look at it if there is enough factor of safety to invest in this. If you already figure out, let's say the business is selling at 70,000 crores. I'm just making it up, okay? And you anyway figure out, it's like there is no way it is valued that way. Then you don't need to spend much time, looking at it, and you can go on and analyze some other stock where you have some conviction that, you know, yeah, there is chance that it is fairly valued. So that's a little tip around that. Now, let's come back here. So we looked at uh, a balance sheet, we looked at the main things of profit and loss. Now, other main important thing is the taxes. So how they are paying the taxes and how they're figuring out the rates. So let's go and look at that footnote here. So that is income tax expense is note number 34. So go that. Okay. So this is the total taxes. So the tax, the way it is calculated is, again, there are certain accounting rules you need to understand. The every large business maintains two books, okay, set of books. One is for the financial accounting. So all what we are seeing is for presenting the financial statements for the shareholders. The other set of books that they have is for the tax authorities. So the tax authorities, the income sheet, if you take out, like, what they submit to the income tax officials, that's totally different. The reason is the depreciation. There are many different reasons. The one of the thing is the depreciation rate they consider for this here, for the financial statements and income tax, can be different. I'm not saying they have to be, but they can be different. Now, because of that, you'll see a different depreciation expense. And because of this timing difference, there can be a deferred tax asset or deferred tax liability. So these are two terms. So uh, if it's a very small term, small amount compared to the overall balance sheet, I would say don't pay much attention. But if, let's say, deferred tax liability is a very big number, it's a very large part of the total liability, then it is. So let's look here, and let's go back to the balance sheet and see what was the deferred tax liability, if at all they had. So if you look at around that, so they have not mentioned anything here, like, they, oh yeah, they do have it. So they have a net deferred tax asset of about 400 crores, and the total assets is about 17,500 crores. So you can say about 5% of that, right? No, sorry, for 2%, 2.5%. That's okay. It's pretty not a very big amount, so we don't need to look at much. So other than that, what's the other thing that we have to look is the tax expense, how they've calculated. So here they do show how they calculated that. So profit before tax was 5,200 crores, right? So here, let's go back here. So that's why I have the footnotes and this so that you can go back and forth. So here they have shown 5,292 crores. It's exactly the same here they have shown. And that the tax rate is 34.6%. Okay. It was same both years. So if you do 34.6% of 5,292, you get 1,831. That's the expense. Now, again, there is certain kind of a deduction they get for like a tax break, 190 crores. Then research and development they do, they get some kind of a credit, and some other things. So now they finally end up expensing 1,569 crores. So, which is not that big a difference between 1,831, so it's good. But sometimes what happens, the this difference is huge. So let's say if this is 1,800 and this is like 500 crores. So usually people don't consider these things, and they, in their valuation model, they'll kind of assume it's going to happen the same way, which is wrong, because the reason of this difference is because that year maybe they got certain breaks, maybe there were a lot of differences, but maybe next year they will not. So a conservative estimate is always to have uh, a total overall rate. Like, you in your valuation model, you should just try to figure out what is the profit before tax. So basically the valuation model, the way it goes is, you first estimate the revenues, then you then estimate what's going to be the margin based on the expenses, then you get the profit after tax, but sorry, profit before tax, and then you have a tax rate, and there I advise you to put like around 35%, and you get that. And that's when you take that amount, and this again before depreciation, and then from that amount you subtract the capital expenditures that are needed to grow the business, you get the free cash flow. So so that's how you have to analyze this part. So we have so now we've gone through. Let's get back here. We've looked at the income statement, we've looked at the balance sheet, and we've got a fairly good idea how things are going on.